So let's kick off the presentation with the reversal that we've seen in the market so far this year. We hit a market high on February 19th, where we then proceeded to see a drop of 21%. We hit the low of April 7th with anxiety at an all-time high. And on that day, Principal Wealth did buy for our clients. And since then, we've now seen a reversal that's up 32%, excuse me. That anxiety is calmed. And now we're at this all-time high that everyone's questioning, where do we go from here?
Yeah, we went from all-time high early in the year to well below an all-time high. So really on the verge of a bear market.
Mhm.
We hit it on an intraday basis, but didn't close there, so it doesn't count. We invested heavily down at the bottom on April 7th. And yeah, we're back up to new all-time highs. How quickly that turnaround can happen. And it's also a good reminder that you just have to really stay invested in good stuff. Markets go down for reasons that are far beyond fundamentals. For this one here, it was the uncertainty around trade, the way it was articulated or not articulated, and sort of the fear of the unknown, right? So
Yes.
there was money in motion. Most of that was due to computers trading very quickly. Most of it was pre-market and aftermarket moves anyways. But here we are, as if nothing happened other than the market climbing, and we're setting the stage for more all-time highs. The fundamental backdrop is solid. There's a lot more certainty than there was 3 months ago, 4 months ago, and you have a scenario where it's very likely the Fed will be cutting rates in September, and will likely not stop cutting them for the next 2 years. So we continue to believe that the setup is going to work well for volatile assets, for risk assets, aka stocks, which is very exciting for us.
No, absolutely. We have a lot of reasons for optimism, and we would start talking about, the forward earnings expectations when you look on the left of this slide continues to rise.
Yeah.
When you look on the right-hand side, profit margins continue to expand and are expected to over the next 12 months.
Yeah, and earnings are rising, so the market moves in the direction of earnings, and you can see the direction of earnings quite clearly on that chart on the left.
Mhm.
If earnings move down and they move down consistently, the markets will move down. But earnings tend to, when there's a bad year in earnings, it's usually washed out over 3 quarters. Businesses find a way, whether it be cutting expenses or focusing on new products or efficiencies, or in some cases raising prices, changing, leadership. They figure it out pretty quickly,
Mhm.
and that is usually the major foundational element to corporations having stock price increases. Right? They
Yeah.
run a good business, they figure it out, they can weather storms, and if they have a blip, they usually come out of it pretty quickly. At least good companies. On the right, profit margins. So the net earnings of companies, right, or the net profit margin, how much they actually capture,
Mhm.
continues to rise as well. We're at all-time high profit margins. So, I think there's some wiggle room up from here, mostly due to the positive benefits of AI and efficiencies. But I don't expect profit margins to continue to rise much higher than maybe the 14.5% level, because we are at historic highs on profit margins,
Sure.
right? So then you make more earnings by more volume,
Okay.
right? So if you have
Yeah.
that profit margin, you just have to do more stuff to create better earnings within that margin, if that makes
Correct.
sense. Yep.
Absolutely. And I think another reason of optimism is looking at business spending, and this in particular is focused on AI in regards to CapEx.
Yeah. So with profit margins at an all-time high, spend more money, spend some of that profit margin to create more efficiency, which creates over time a bigger profit margin. So here's one slice of a subsegment of where businesses are spending money. It's pretty substantial, though. It's spending on artificial intelligence, because what it's starting to show is you spend money on artificial intelligence, it is creating a tremendous wave of efficiency. And the chart on the left shows just a shocking sum of money being spent and projected to be spent on artificial intelligence.
Mhm.
So CapEx, government term, is capital expenditures. We're looking at, business CapEx here, and we are expecting businesses to spend lots of money, and that is good for the economy. That is good for the markets. Especially when it results in productivity gains and higher earnings.
And Bob, when you say businesses spending money, we're talking about how businesses are acquiring or upgrading, maintaining their physical assets.
That
This is long term.
services, technology, planning for the future, locations. With the passage of the most recent bill, the big beautiful bill,
Mhm.
there are depreciation rules. If you're buying tractors and heavy vehicles and machinery and you're building stuff, there's going to be a lot of capex coming, which means market should do well, economy should do quite well.
Yeah, great. And on top of these businesses planning longer term and spending, there is a ton of money in motion right now.
Yeah, so Juliana, people are starting to pick up on some of the conversations around trade that Scott Bessent, head of the Treasury, is having, the president's having. They are talking about tariff rates and trade deficits, and what you're seeing is the countries that have the lower tariff rates have agreed to spend money in the US. Right? There's a direct correlation.
Yeah.
If you smile, if you're nice, and you lead with, we're willing to spend a lot of money in your country, your tariff rate seems to be much lower than some of the others,
Mm,
right?
yeah.
And here is a very short term blip up in the impact of that. And what you see here is there's a lot more US capital inflows that are coming in very quickly.
Hmm.
You can see it on that chart. It's just a straight up arc.
Yeah.
And I believe if we check this again in 6 months, that line will be way higher,
Okay.
way higher.
Yeah.
And that money is to not only come here, it's to be deployed in business building activities based in the US.
Right.
So something to be mindful of, and it's something that we will be watching. That's a good thing.
It's a good thing. Yeah. And so, we've highlighted a few good things. And the last slide we have as it pertains to the markets, I think is such a reminder. It's an oldie but goodie in terms of talking about, you have to tolerate volatility and you need time to get the good results that we're all looking for.
Yeah, I mean, our first slide covered the wild all-time high in February, 20-ish% correction down to April 7th, and then a wild 30% rise up from there.
Mhm.
Um, it's imagine people jumping out of the market in April,
Yeah.
right?
Hmm.
And not getting back in. You missed a 30+% ride in the market. So you really have to understand, if you're going to go out there surfing, you have to understand that there are big waves, there are small waves, and a lot can happen,
Yeah.
right? So before you go surfing, you have to have a basic understanding of what happens,
Hmm.
right? And if you do, your expectations are set properly. So when you fail, short term, when you're surfing, you
Hmm.
get back up, you get on the board, and you'll figure it out. Same thing when you're investing.
Yes.
You have to understand that volatility is normal, and the reward for tolerating volatility over time is good returns.
Yeah.
It's super simple. So it's always helpful to remember that the market will likely experience about 5% pullbacks per year. Excuse me. You should expect one correction of about 10% per year, one correction of around 15% every 3 years, and a correction of about 20% roughly every 5 years.
Every 5 years.
Every 5 years. And the reward for that is about an 11% annual return on stocks
Hmm.
since 1950.
Yeah.
Yeah. Well, if you want that, you have to tolerate what's on the left hand side.
Yeah. And if I could also add, we talk about this all the time. the largest attributions of these corrections are not necessarily anything fundamental in the market. It's more of an emotional reaction.
Usually overreaction.
Yes,
Yep.
exactly.
Yep.
So no, I think that's a good way to end the markets section of this
Mhm.
webinar, and let's move on to the um, economy and policy and start with the Fed meeting as it pertains to their last July meeting.
Yeah. Yeah. So there's a lot of weight now on the Fed, a lot of eyes on the Fed. There's been a resignation or retirement, I should say, of one of the voting members. There will likely be a retirement of Jerome Powell that is coming early next year. And what we have here from the July meeting is a Fed that is really getting ready to do something. That's how I'll explain it.
Mhm.
They weren't ready in July because they didn't want to do it in July, but they are getting ready to do something, which will likely be articulated this month in August at their vacation meeting and then executed upon in September. They addressed a lot in their last press conference. Number one, that they understand that high short term rates, the things that they control, are restrictive. They're moderately restrictive, which means the economy is functioning well even with these high short-term rates. They address the fact that inflation, both measurements of it are in the twos, which is
Mhm.
great. They address the fact that tariffs will likely be short-lived with any impact on inflation, and they were starting to refer to it as a one-time shift, right? Because if prices with tariffs are adjusted because of tariffs, they'll be adjusted once.
And Bob, how many times did they reference that in their meeting? Because I know you counted.
So they finally admitted that, so much so that they mentioned it. This is Jerome Powell in his press conference that came after the written statement on July 30th.
Mhm.
He mentioned it 7 times in the post meeting press
Post.
conference.
Yep.
Yeah, one time shift, one time shift. So it's almost like he's downplaying any potential inflation from tariffs.
Hmm.
And if he's downplaying it and not using it as a barrier anymore, you have to understand this, nuanced language he's using. He's sort of just pushing it aside to say, all right, now on with the mission.
Right.
And I think that's exactly what's going to happen in September. Let's stop worrying about tariffs and start doing something now.
Yes.
So we firmly believe that the Fed will cut rates and they likely won't stop for some time.
Mhm.
We in-house think that there will be 3 or 4 cuts before the end of the year, which ironically would mimic last year. They
Yeah.
started in September, ended in December. We think the cadence will look very similar. And we even think next year they probably have 3 to 4 cuts in store as well. They may do them quarterly.
Okay.
Yeah.
Yeah.
So we shall see. So here's sort of where things stand as of 7:30, but something did happen that same week. So they met on a Wednesday, and on Friday something happened, but we'll get into that in a second.
Yeah.
What you did see with this meeting, I do want to talk about this, is you had two dissents. So two voting members disagreed with the board, and the last time that happened was December of 1993, right? So you had two dissents. Two voting members said, "Hey, I think you should cut rates. I don't think we should hold tight here."
Amazing.
Hey, good for them for speaking up. We put a quote in here: if everyone is thinking alike, then no one is thinking, from Ben Franklin, right?
Yeah.
So don't you have boards and committees to have differing views and opinions?
Absolutely.
Isn't diversity of opinion a good thing, right? So we haven't had anyone really speak up in 30 years,
Since I graduated high school.
40 years, right? I mean, come on. If you're part of this committee, you're
It's
just
really,
agreeing with what's happening.
yeah.
Look at the amount of agreeability that has happened since 1993
Yeah.
up until now,
Yeah. With
right? It's
some
okay to
really,
disagree.
really directional pendulum swings
Yeah,
along the way. Yeah.
yeah. So if we don't like policy, well, maybe we should change the people on the board so there's a little bit more due diligence
Mhm.
and testing and taking the other side. right? That's how
Sure.
you have good debate. That's how you get it right.
Yeah.
So one would say if policy was wrong for the past 20 years, it's because no one spoke up over the past 20 years.
Yeah.
It's rare. So hopefully with future Feds, there's, a group of people that take the other side. I mean, even just to take the other side.
Yeah.
Sometimes you don't have to believe in it, just take the other side. You might learn something from that.
Absolutely.
So, two dissents made the news. It's like I feel like no dissents should make the news, but anyways.
Yep. And another topic that really made the media is this jobs revision.
Oh, you don't say. So this also made the news. The Fed meets on Wednesday, July 30th, to talk about the fact that we're near full employment. The jobs picture is pretty steady. Inflation remains low. Tariffs, if there are any inflation, will have a one-time effect, so on and so forth.
Mhm.
And then 48 hours later, we have the single biggest revision to the jobs number, to the 2-month rolling jobs number ever.
Yeah.
So, it's a big deal. Sorry, outside of COVID. But COVID, you got to get people to respond to these surveys. There was other things going on in COVID. So
Yeah.
the only other outlier events here in a negative way were COVID,
Mhm.
right? So prior to COVID, this was the biggest revision in a 2-month period of time in history,
Right.
right? At least in a negative way. So that's why it was a big deal in the news. And, that's why you could see some rationale behind the president firing the person who is in charge of, you know, overseeing the accumulation of the data that gets put out.
Right.
Last year, there was a larger revision, yes, of 811,000 jobs right around the same time last year, but that was from a year to date standpoint. So that was 8 months of data being revised.
Right.
This was
May and
two,
June.
this was May and June, two
Right.
months of data. This was pretty significant. So significant that it moved the unemployment rate up from 4% to 4.25.
Mhm.
So had the Fed known this, I think that meeting would have turned out a little differently.
Okay.
Which is why the odds, according to the Chicago Mercantile Exchange, of a cut to interest rates in September are now about 90%.
Okay. And you look at these revisions and you have them, you always have them over time, and you have these justifications that there's seasonal adjustments, you have weakness across sectors, and in particular government from everything that transpired this year. But there was one other reason that you wanted to touch on.
Yeah. So I've been super critical of the Fed relying on data, right? Because the data that they rely on, and you've heard us talk about this, is stale. It's backwards looking. The
And
you
we
want to
talk a lot about that with inflation,
We
correct?
talk a lot about that with inflation,
Yep.
amongst other things. We also know that the employment data is flawed, especially when you have to rely on surveys and people and businesses responding, right? They could be in a bad mood, they could be on vacation, right? So then what's important? Well, participation rate,
Hmm.
right? Answer rate, actually answering the questions that are asked. What you see here is over the past, I don't know, decade or so, there has been a major decline in the response rate of the data.
Yeah.
So why would you depend so much on stale data
Hmm.
if it's even weaker data?
Yeah.
So stale, weaker data, I don't know that I would rely on any data as heavily as the Fed is to make critical decisions.
Yeah.
The prior Feds, so the prior Fed regimes, by Janet Yellen, and prior to her was Ben Bernanke, they were forward looking. It's actually a thing, right? They actually referred to it as forward looking guidance,
Hmm.
which meant, yes, we look at the data, but that doesn't do anything
Determine the
for us.
decision.
Yeah,
Yeah.
it doesn't sway us. We want to look forward. We
Correct.
want to see what the new trend is,
Hmm.
right, to help make our decision, because
Yeah.
we don't want to be late. We want to get it right, so on and so forth. This Fed uses backwards looking data that happens to be quite weak data
Hmm.
because the participation and response rate is significantly lower than it has been.
Yeah.
So, when you a lot of people are saying, hey, the Fed is just sort of out of touch, out of tune. They're talking about stuff that doesn't make a lot of sense in the real economy. Yeah, because they're relying heavily on this stale data with a low response rate. So articulating why we've been critical, I think you can kind of see it clearly now.
And, speaking of stale data, let's talk about inflation.
Wow, look at you, Julina.
I know.
That was a backhand slap to someone. It wasn't us, of course. But
That usually comes from you. Everyone's
that was
surprised
very
it's coming from
smooth of
me.
you. Thank you for that. See, wow, you're really good.
Yeah.
So anyways, our two measures of inflation, headline and core PCE, again in the twos, and they'll be
Mhm.
there for some time.
Despite tariffs.
Right,
Let's talk about tariffs.
right. So tariffs really haven't shown up anywhere in inflation, and I can talk briefly about that. Part of it is because if you're exporting goods, right, because where are you going to see inflation? Exporting goods. So it's the
Correct.
consumption of goods here that came from overseas. Well, number one, the exporters have received a positive bump in currency. Their currencies have strengthened versus the US dollar, number one. Number two, they don't want to lose wallet share to the largest consumer on the planet, which is the United States, right, from a dollar standpoint. China and India being the largest number of consumers, but US has fewer consumers, but we consume a ton. So you don't want to lose wallet share to the US. So what happens? Well, the exporters of stuff take it on the chin.
Mm-hmm.
That's why there is no increase in inflation. Period. End of story. The exporters don't, even though they know there's going to be a cost adjustment when it gets here,
Yeah.
they will adjust cost on their side, which is why you don't see wholesale prices rising, right?
Overall.
There's a reason for this. Yep. So PPI, which nobody seems to pay attention to, is incredibly low. Number one. Number two, those businesses overseas and the exporters of goods have made maybe a little bit more profit net of a price decrease. Why? Because of the currency exposure that they have, number one, and the unwillingness to lose market share, wallet share to any other competing countries. Does that
Okay.
make sense?
Yeah,
Yeah.
absolutely.
The flip side to tariffs, so the money collection side, has resulted in a heck of a lot more money coming into the US government. Let's call it a tax, maybe not a tariff, a tax on goods, foreign goods.
The
And
jump.
this will keep coming.
Mm-hmm.
This will keep coming. So it will keep coming until I guess the president says otherwise at this point.
Right. More revenue is good. Another way to maybe look at tariffs is looking at some of the adjustments here.
Yeah, countries sorted by largest trading partner to smallest. There's too many to list, and honestly, we probably should have stopped at the UK because anyone below that line is really, we're talking 1 or 2% uh, uh, sums of exported goods to the US. So in Europe, really individually, those countries don't mean much, but glued together, they end up being the largest trading partner, followed by Mexico, then Canada, then China. How about that? So this is sort of a chart of just where the tariff rates stand.
Mm-hmm.
And you got some at 10, you got most at 15, and a few above that. I know Switzerland is trying to get their tariff rate down, mostly because they sell a lot of watches here. Myself being a watch collector, I hope Switzerland does negotiate it down to zero. So we shall see.
One more slide on tariffs in regards to where the inflation rate is.
Yeah, this slide is courtesy of Kyle, who just wants to beat this topic over the head with a sledgehammer. Where is the inflation? Tariffs. And again, just a chart that shows US import price index in June was negative.
Right.
Let's repeat that, negative.
Right.
And if you exclude petroleum, it's still low. It's right around, less than 1.5. So again, stuff that's coming over. This is the index. Where's the inflation?
Right.
We don't see it.
Yeah. And I think this is important because it's really easy to hone in on one key area in regards to the effect of tariffs on inflation, and then
Yeah,
to imagine that spread across all sectors and all goods and services. And that's just not the case.
that's right.